In all these emerging markets, everybody's focused on the currency. I mean, the first question I get whenever I talk about emerging markets, clients say, what about the currency? Is there a risk in the currency? So, and of course, the central banks are supposed to be responsible for a steady currency and a currency that's not volatile. And so whenever you see a central bank being a leader being replaced, that creates a panic, despite the fact that if you notice the statement about the new central bank governor in Turkey, his objective will be to have a stable lira, Turkish lira. So I think it's probably the reaction was overdone. I think did not make sense to have that kind of reaction. But it was expected that whenever you have this kind of change, the currency will get weaker. But I don't think the lira will continue at this weakness. I think it will be steady going forward.
Mark, as you say, when we talk about investing in emerging markets, we immediately think about currency. We get nervous about can we really protect it or not. So you are the leader in history of emerging market investors. How do you protect yourself as an investor against currency fluctuations?
Well, what we do is we try to look at purchasing power parity as one measure and other measures of whether we think the currency will get stronger or weaker. And then if we see that the currency is going to get weaker or is getting weaker, we then make a choice of stocks which will benefit from this weakness. So in some ways, a weak currency can actually help us to perform better. So for example, in Turkey, we have one investment in a software company that exports its products. So they're getting foreign exchange coming in, and of course their costs are in Turkish lira, which is getting weaker. So that's the kind of thing we take into consideration. So we try to emphasize that currency can be your helper instead of your detractor.
Mark, one of the big subjects in the United States, but I think it also applies in emerging markets, is the so-called reflation trade. Is it coming? Is it here? Has it already had its time? For example, oil prices actually started to come down over the last week or two, although they spiked up briefly with that Suez issue. What do you make of the reflation trade? As an EM investor, is this the time to go in for the countries and the stocks that will benefit from the reflation or not?
Well, first of all, I believe that looking at what the Fed is doing, we're not going to see a big spike in the inflation indices that we measure, CPI. As you know, I'm not a great believer in those statistics. But anyway, you're not going to see a big spike in those numbers. And of course, the emerging market countries, in fact, the world, Europe included, looks at the US and concludes that, hey, inflation in America is not going anywhere. Therefore, we're not going to get hit with that same kind of situation. So the expectation is, first of all, inflation will, as measured by the CPI, will not raise its ugly head, number one. Number two, the US dollar will get weaker because of the big spending program that the Biden administration has. And of course, we're already seeing emerging market currencies getting stronger against the US dollar. There's been recently a little spike in the US dollar index, getting a little stronger, but basically, the US dollar index is at a weak point and probably will get weaker going forward, which again is very good for emerging markets.
When we think about technology and emerging markets, we tend to think about Asia, as I say, particularly certain parts of Asia. Does that necessarily lead you to focus on those areas, or may there be some areas that we might be overlooking that both are technology and emerging markets?
Well, it is true. If you look at our portfolio, you'll see Taiwan is big, Korea is big, mainly in these technological areas. But we're also in India in the technology area, in software. And if you look at a place like Brazil, they're doing a lot on the software area in terms of internet shopping and that sort of thing. So we consider the technology area very, very important in every one of these countries because every sector is being hit with that. But it's true that the emphasis, of course, is on Asia now. Not only because of the technology, but because of the growth. The growth is better in Asia rather than compared to the other parts of the world.
Coming back to the United States, one of the remarkable stories of the last month or so has been the dramatic shoot up in the yield on the 10-year. Now, let's be frank, it's still at a reasonably modest level compared to history, but it still went up really fast, faster than it has for a
Yes.
long time. Does that put a lot of pressure, do you think, on your emerging market investments?
So far, no, because if you look at the U.S. rates compared to what people in emerging markets have, there's a big gap. Emerging market rates are much higher in most cases, not in all cases, but in most cases. And it's true that, and if you look at the change from what -1 to a +1 or something like that for the U.S. rates, I think it's 0.5, -0.5 to 1. The percentage increase is tremendous, but actually the rates are still very, very low. And that, of course, is a bellwether for rates around the world because the bond buyers are looking for yield and they're not going to find it in the US. So what they do is they go abroad, which is why you're seeing a lot of the emerging market companies and countries selling more and more bonds, offering very attractive rates to the bond buyers in the US and Europe.
We've been talking largely about equity investments in emerging markets. What about debt? What about fixed income? Are there opportunities there that people should be taking a look at?
There certainly are opportunities, but I think it requires a lot of caution because, as I mentioned, a lot of these countries with relatively high risk in terms of being able to pay back their bonds are attracting lots of money and therefore are benefiting from low rates. And those low rates may not really reflect the risk that is inherent in those bonds. So I would be very, very cautious in that regard. There are, of course, very good opportunities, but we have to make sure that whenever we're buying a bond in emerging markets, for example, the yield that you're getting reflects the risk that you're facing.
With respect to equity investment in emerging markets, talk about earnings and projected earnings. Obviously, the value of a stock largely is tied to the expected future earnings for that stock. You said you pick individual companies, but do you also see in categories of countries certain likely increase in earnings? I mean, a rising tide, as they say, lifts all boats.
That's what's happening now. If you look at the earnings growth overseas, by the way, earnings growth outside of America is higher than the American stocks. Of course, American stocks earnings growth are moving up as well, but you see the earnings growth numbers in emerging markets is very, very high. And that's because of the recovery that we're seeing. Despite the fact, by the way, that these emerging market countries don't have a high degree of vaccination. For example, China is way behind the United States and Europe in terms of vaccinations. I should say United States and the UK. Europe is sort of in the middle. But if you look at the numbers, they're way behind, but the Chinese economy is doing very well. So you're seeing this recovery in these emerging markets, which reflects in the earnings per share growth.